Okay, well, I said to say in the first hour we'd have a listen to Steve Keen, who's an economist, who will give us a bit of a breakdown of what he thinks is really important about Brexit and also about Mario Draghi's decision last week, the chairman of the European Central Bank in Frankfurt, to stop quantitative easing, given the fact that QE is the only thing over the last 2 years that's been giving any growth in the eurozone.
I'm Professor Steve Keen, author of Debunking Economics and the world's first crowd-funded economist on Patreon. Well, quantitative easing has been the central bank's attempt to boost the economy after the financial crisis by trying to generate what they call a wealth effect. And the idea is that if they buy bonds off the financial sector, that means the financial sector has to buy something other than bonds with its money, because it can't sit just with a pile of cash, which it gets by selling those bonds to the central bank. So the financial institutions go off and buy shares, possibly property, boosting the share prices for those who own shares, who therefore feel wealthier and spend a bit more money consuming, and that makes the economy recover.
As a financial institution, who are these people? Do they include the private banks like HSBC, NatWest, these people?
Yes, it does. It includes all the banks and all the what they call shadow banks. So the Federal Reserve can directly buy assets off the banks because they all have accounts at the central bank, and they can indirectly buy them off companies which are shadow banks as well.
So they're buying bonds. What are these? I mean, I imagine that they are repayable over quite a long period of time, and that they're for vast amounts of money. Yeah,
I mean, the usual things that the central banks do is they engage in what they call open market operations, which they abbreviate as OMO. And that is where they buy and sell bonds, normally government bonds, from financial institutions with the intention of trying to maintain the interest rate that they've set. So this is a standard thing. Banks have been doing this for decades, if not centuries. What they did with quantitative easing is they said, we promise to be on the buy side in the argy-bargy of all this stuff. That sometimes they are mainly buying, sometimes they're mainly selling, depending whether they want to drive interest rates up or down. But for QE, they said, we are going to be on the buy side no matter what, every month indefinitely. And in America's case, I know the Americans' figures fairly well, they promised to be on the buy side to the tune of $80 billion per month, which is $1 trillion per year, basically. And Draghi's been doing much the same for Europe. So it means in all these open market operations, netting out each month, they're going to be buying about 80 billion euros more than they sell.
The Germans said, well, we can't do this, we're not going to do it, and they resisted this for a very long time.
Yeah, well, for two reasons. The Germans have got a fear of inflation. Their theory was that if the central bank does this, that's going to boost the money supply and cause inflation. Of course, it hasn't happened. The reason being that when you buy bonds off financial institutions, the only things those financial institutions are legally allowed to buy with that money are other financial instruments. So if you buy bonds off them, they've got to buy either bonds or shares or property. And, of course, the easiest thing for them to do is buy shares. So a large part of the share market rally for the last decade has been courtesy of financial institutions having sold their bonds to the central bank, then used that cash to go and buy shares.
So what's going to happen, do you think? Now we've heard that from January, the eurozone and Mario Draghi and his friends are not going to be carrying on with this QE. It's all going to come to a halt.
Well, they're calling, in place of quantitative easing, they're calling quantitative tightening. It reverses the process that the QE goes through quantitative easing. So quantitative easing, say they're going to buy, say, €1 trillion worth of bonds a year. That gives financial institutions €1 trillion worth of cash they've got to dispose of some other way. They buy $1 trillion worth of shares, driving up share prices. Now, if they're going to go into quantitative tightening, the reverse process occurs. So the banks say they're going to be on the sell side, $1 trillion worth a year. To balance that, the financial institutions have to raise cash. They'll raise cash by selling shares, so share prices will fall.
Will it be a gradual fall in share prices?
Nothing ever happens gradually on stock markets. And I think you can look at the American market and see what's actually happening over there, courtesy of their switch from quantitative easing to quantitative tightening. This year apparently will end up being the worst year for the stock market since 1929. So it's been a substantial fall in stock markets, 10 and 20% levels of share price falls. So once it starts happening, they'll realise that they can't actually do it without causing a stock market crash. And for that reason, I expect them to do quantitative tightening for a while, then give up and go back to quantitative easing again.
What about people like Mario Draghi, the European Central Bank? Do they know what they're doing?
They haven't got a clue. They're all trained in neoclassical economics. They all swallow this vision of the world when, in fact, all that monetary policy is supposed to do in the neoclassical world is to adjust how much investment occurs and adjust when we consume. It's not supposed to have any effect on credit because credit doesn't matter in their models. Now, credit is absolutely essential to a capitalist economy. And when you vary the interest rate and vary the amount of loans and stuff, loans you're generating, you vary demand in the economy quite directly. So they're playing with tools they have no idea of the way they work because their model of how the economy operates leaves out banks. Banks, debt and money don't exist in their models. So if anything, get anything right, it's by intuition because their models actually lead them astray.
So if someone down the pub is saying, well, these bankers seem to be on another planet, that could be true.
It's true. I mean, they've got an intellectual planet where the economy is always tending towards equilibrium, where the financial sector is a source of frictions rather than being a lubricant, where the level of credit and debt doesn't matter at all. That's not the planet we're on.
What about the likes of the big private banks like Deutsche Bank, HSBC, versus the central banks like the Bank of England? Is there really any difference in the way they operate?
Oh, there's a huge difference because the central bank has got an unlimited capacity to create money because nobody is ever going to refuse to accept a £1 note or a deposit in their bank account from the Bank of England. It's very different for the private banks. Because they don't have the capacity to get into negative equity. So a central bank it doesn't matter whether its assets are greater than its liabilities or not. Whereas for a private bank, if its assets aren't greater than its liabilities, it's bankrupt.
But these private banks are not going to go bankrupt, Steve. We saw that in 2008. Surely, we were told that they were bankrupt. They just got bailed out with public money. So surely they're not subject to bankruptcy in the way that you're saying. We've seen that in 2008.
Well, they don't. They avoid it because because of the way that economists don't understand how the monetary system operates. They encouraged all this lending in the belief it was a good idea. And then when it turned out not to be one, they rescue them for making the mistakes of the lending. So, yeah, in that sense, the private banks have got the regulators by the short and curlies. They just believe that, you must have a big financial sector or the world will end. It's classic. You remember the old movie Blazing Saddles, where to try to get rid of a town that's opposed to a railway going through, the Mel Brooks governor sends in a black sheriff. And the black sheriff has all these guns pulled on him and realises he's got to get out there with a bit of quick thinking. So he puts a gun to his head and says, anybody moves and gets it. And they all stand back and don't let him shoot himself. In a sense, that's the trick that the private banks have pulled on the central bank. They make the politicians think the world needs banks to be the size that they are, when frankly they should be 1/4 as big as they are.
But so would you have approved in 2008 of seeing the cash points freeze up and people losing their deposits?
No, I would 100% guarantee deposits, but I'd sack all the bank staff, terminate their bonuses, and write their shares off and nationalise them until such time as they can be bought out by managers who'd be forced to be more responsible in future.
But I mean, surely effectively they were nationalised.
Yeah, we didn't have any ownership with the nationalisation, which is nonsense. There should have been a major ownership stake as well as handing over the money. So that was the worst possible world. You buy them out and then you don't hang on to any ownership when you buy them.
What about countries like Greece, Italy? They're now actually regretting giving up their own control of their own financial policy, the lira, the drachma, that sort of thing. They're hankering to have this back. Are they right to do that? What did they give up when they gave up their own central bank and their own currency?
Oh, they gave up virtually everything. If you think about the policies that you can actually execute to try to control an economy, you have fiscal policy, monetary policy, to some extent exchange rate policy. Even with a floating exchange rate system, if the lira still existed and Germany had a lower inflation rate than Italy, then over time the lira would fall against the mark, and that would slightly correct the change in inflation rates. With the euro, Germany's been running an inflation rate of 1%, despite the fact that they agreed to target 2%. Italy's been running 3%. It's not a major difference, but over a period of 15 or 20 years, they compound so much that Italian industry is uncompetitive compared to German industry. So it's a huge thing to give up. Now, the only way you could actually survive that is getting more fiscal freedom, but they threw that away as well. So rather than having the capacity to run large government deficits, which you need to balance a decline in your exchange rate or a decline in your terms of trade, they were forced to have tight fiscal policy as well. So it was a suicide pact right from the outset.
What about Brexit? Do you think it makes a lot of difference one way or the other as to whether Britain stays in the single market, stays in the customs union, stays in the EU effectively? That's even on the cards now.
I was one of two, myself and Richard Werner are the only economists to say Brexit is no big deal. And we're both critics of the European Union. We both think the eurozone in particular should cease to exist, so we both voted for Brexit on that basis. It's been so badly mishandled by May, it's just beyond belief. She should have done what Jari Varoufakis said back in 2016 and just basically put a Norwegian deal on the table and say nothing, no negotiations, because she's been given the complete runaround in Brussels by bureaucrats who don't want to lose member states, they want to gain member states. So it's been a catastrophe overall. And if you move out of the customs union and you face tariffs against to Europe, in terms of the pricing that's involved, you could have a major fall in the exchange rate, which would compensate for the increase in the prices of the tariff in terms of the cheapness of British goods inside the European Union. So it might have very little impact overall. The main thing is just the sheer physical practicality of getting goods through customs approval. That's the main difficulty that's faced.
Any idea which way you think it's going? Do you think there will be a Brexit? Will there be a deal? Or will it be no Brexit? Will they say, oh, well, actually, we don't think it's a good idea to leave at all?
As long as May's in control, the one thing she's adamant about is ending free movement. And that's one thing she's got in common with a lot of people who voted for Brexit. They blame the migrants. I think there's a fairly high likelihood it'll all fall in a funk and nothing will happen on March 29? I can see it just not happening because May's proposal won't get through Parliament. And the chance for anything to get through Parliament, I think, before March 29 is pretty much zero. So it'll get there, basically click over and it'll be rolled on and you'll have another year of talking about Brexit. Any
ideas when the lack of QE from the European Central Bank is really going to start to kick in and the stock markets are going to start to slide?
Well, as the QE is in first, the UK is entirely controlled by the Bank of England. The Mario Draghi stuff does nothing for Britain because Draghi doesn't produce pounds, he produces euro. So it won't be any direct impact out of quantitative tightening in Europe on the UK. It's more what does it do to the trade position of the UK? And frankly, the UK shot itself on the foot in the last 20 or 30 or 40 years by deindustrialising, in the belief that that it can sell services to make up for the decline in manufacturing exports. That hasn't worked. You've gone from having a trade balance to a trade deficit of about 3 to 5% of GDP. And as John Mills argues, that's partly because the pound's overvalued because London's the world's major money laundering centre. So you'd be better off having a massive fall in the pound and get a chance to revive manufacturing. And on that front, just to give you an idea of what's happened in the last 30 or so years, about 20 or 30 years ago, manufacturing was about 20% of British GDP. It's now 10%. The same period of time ago, manufacturing was about 22% of Germany. It's still about 22% of Germany. So UK has basically bashed itself up by destroying its manufacturing sector. And I'd rather worry about how you revive that than worry about Brexit.
On the podcast, I put the full version of that, but Martin, basically, he's saying that he doesn't think Brexit's going to make any difference at all to the economics, but QE might well do, and once the stock markets start hitting the floor around Europe, then they'll have to start doing QE again.
Well, I think it's certainly the case that there's going to be a crash, Brexit or no Brexit. I mean, that's really a storm in a teacup compared to the fundamental problems of the financial services sector globally.
What will trigger that crash?
Well, it could be by accident, Brexit might be the trigger, but it could easily be the collapse of the Italian banking system. I would suggest is the most likely trigger at the minute. But it could easily happen from something completely different that nobody even thought of yet, because the whole thing's a house of cards. Whether you've got a house of cards, you only have to take one card out, and the whole thing falls down, and any card will do.
Well, he seems to think that's what will happen anyway. So there'll be a collapse in share prices, and then they'll have to start QE all over again in the eurozone in the new year or in the spring, as all the effects of their stopping QE starts to kick in. So you'll find the rest of that on our podcast, which you'll find on our show page at thisweek.org.uk. But I'll leave you this week with a guy called Sammy Wilson. He's what you might call a Brexit comedian.
The EU, as a punishment to the people of the United Kingdom, are demanding that the price of leaving will be to break up the United Kingdom. We won't let them. I've only got 10 minutes. These are not my notes. But I brought it along tonight because I wanted to show you what we're going to pay £39 billion for. £700,000 a page, nearly. And every page carries an obligation to bow the knee to the EU.